Hello, everyone. This is Dr. Duru with the Market Breadth from Ahan Analytics. All right, let's get right into this. It didn't take long. Right after I described a market that had gone from fragile to fearless, the market's next challenge is in front of us. We have more geopolitical conflict. You can see the big screaming headline here. Israel bombarded Iran. They have retaliated. Oil spiked, and we had a small sell-off. I mean, actually, the sell-off could have and should have been a lot worse than it ended up being. And we'll take a look, of course, at some charts. But the risk quotient has once again gone right up. So we have to take proper precautions. And I'll again talk about that as I go through the charts here. But let's look at the timestamp. It is June 13th after the market closed. You can see all of the important headlines about oil spiking, geopolitical conflicts. We see another IPO that has gone crazy, this drone maker Arrow. Um, we have, let's see what else. Oh, right. And then, of course, Tesla keeps making the front lines, and we could see sales weakness is showing up in the US, which is, of course, no surprise. The surprise will be how resilient the stock will remain, just because that's the way Tesla stock is. And I think that's the top headlines. Let's go ahead and jump right into these charts. Now, the big upshot of today's increased risk quotient is that the market's overbought period has come to an end. It lasted 5 days. And according to my AT50 trading rules, this is AT50, what you're looking at here, short for above the 50. And in TradingView, it's the percentage of stocks trading above their 50-day moving averages. It's my favorite technical indicator. I love to trade off of market breadth, particularly at extremes. So we had an extreme here in buying strength and buying power that has now receded. Now, according to the AT50 trading rules, once the market leaves overbought conditions or it fails at overbought conditions, it's a bear signal. But I'm not yet ready to flip from bullish to bearish because the market is well supported. I keep repeating this theme. The market is well supported. The market is well supported. Hopefully, by now you all have gotten what I mean. And what do I mean? Well, let's take a look. Actually, before we take a look at the indices, let's take a look at what happened to the percentage of stocks trading above their 200-day moving averages, because this may be even more important right in this juncture, which is the percentage of stocks trading above their 200-day moving averages did break out to a new high. You can see it's nowhere near its 2025 high, much less the highs from last year. So we still have a significant number of stocks that are lagging, even though the 50-day moving average was a major hurdle for them to get over. This longer term indicator of market breadth still is not completely healed from the tariff trauma and drama from basically from February through April. So this is something to watch, right? Because it did break this primary trend line, but the trend line as defined by this blue line here is still intact, the downtrend line. Okay, so what do I mean by well supported, and what do I mean by not getting bearish just yet? Well, let's go to logarithmic. You can see here that, the pullback in the S&P 500 is very mild. It was 1.1% today. Like I said, it could have and should have been a lot worse given the increased risks now that are out there. The first support line here is now converged with the 20-day moving average, which is the dotted line. And this line here, which is the first post-election close. If I go all the way back to November, you see how after the election results, the next day, sorry, the market closed right here, and it has worked as a good pivot and support and resistance at alternating times. It worked as support when there was a small pullback back on last week. In fact, it worked out very perfectly. And for now, I'm going to assume that the S&P 500 will fall back to this line and it will hold support again. Even if it doesn't, look here, we have the 200-day moving average, which is now uptrending, the blue line, as support, waiting for any pullbacks. And we have the post-election, sorry, the pre-election close. So sorry that I'm saying this wrong. The close on election day. That's a better way of saying it. Still relatively converge, and it's again holding out as firm support. And even if that gives way, we have the 50-day moving average, which is the red line holding out as support. So what are these levels? Let's say it's approximately 56.75 at the worst case scenario. Actually, I'll just call it the bad case scenario. Let's call this like 5,800 or so on the S&P 500 for the medium bad scenario, and the good soft pullback scenario, we have 59.41. So those are the levels to keep an eye on. Obviously, if the S&P 500 falls below the 50-day moving average, then it's right back to bearish territory. I have a big dilemma when it comes to my AT50 trading rules, because while I'm not going to flip bearish, I can't I can't maintain a firm bullish stance. So, for instance, if this support gives way, I'm probably going to go neutral on the market and really just be a lot more cautious and wary about what's going on. And just watch it how this area resolves itself. So, what are some of the things? I think this is a time for risk management. If you've enjoyed some great profits, once you were buying here along with me at these oversold conditions, just start taking some profits. Lock some of that in. It'll give you more resilience and more resolve to hold through whatever kind of pullback is coming, and some extra cash to deploy on things that pull back that you really want to buy or buy more of. The other thing I started to do actually before today was I actually got a December S&P 500, sorry, December SPY put spread. I think I did a 560 to 540 put spread. That's sort of my backstop hedge. I mean, it's not going to cover all the losses I might have on another big pullback, but I just like to have a hedge in place like that. So today, what I did is, in further risk management, I took profits on a 610 calendar call spread that I had, with the short side expiring next week, and then the long side expiring the week after that. So I was so tempted on Thursday to just go ahead and take profits and call it a win, but I decided to hold out because it looked like the S&P 500 was going to break out, and certainly I expect that the index would have broken out up into this range to finally challenge its all-time high, if not for today's news, really is last night's news. So that's where we are on the S&P 500. It's still bullish, but it's risk management time, with market breadth AT50 falling below or falling out of the overbought territory. Let's look at the NASDAQ. You can see the NASDAQ actually is, to me, is more definitively topped out here. It fell short of challenging its all-time high. And, it's probably going to test the 20-day moving average and so on. And we could see again, the NASDAQ is as well supported as the S&P 500. Now, IWM, the ETF of small caps, the iShares Russell 2000 ETF, look at that. It came within a hair of 200-day moving average resistance. And from that point, in 3 days, it jumped right back down to 20-day to support at the 20-day moving average. Now, I was so wrapped up in other things, I forgot to take a look at IWM all day. Shame on me. I probably would have been tempted. I would have been tempted to buy here. I probably would have bought a next round of call options just to see if this support would hold. But as I keep saying, I don't mind if I miss these kind of trades, because I have a large core position in shares of IWM. So I'm never sad or regretting anything if IWM turns around and jumps up. It's always going to be a benefit. But anyway, one thing I had claimed earlier is that IWM would test its 50-day moving average support before testing 200-day moving average resistance. Looks like that was flipped, and actually it did test resistance before officially touching support. Unfortunately, now I suspect this is the time that it will eventually test this support again in coming days or weeks. All right, now here's another thing. Talking about missing stuff, here's another thing that I really, really missed with the VIX. And I've been emphasizing the volatility index again because its movements have been meaningful again. There was a time, long stretch of time before this year, when the VIX really was meaningless, but now it's become full of meaning. Look at how it declined steeply and then steadily but surely right back to support, which is which is the level. Let's see, what is this level? 16.98. Let's just call it 17, which was the launch point for all the tariff noise, trauma, and drama from March through April. And it almost tested it. That's a close enough test here in May on the pullback in May, on a small pullback in May, launched higher. We had that week where suddenly volatility jumped up, and then it just resumed its steady, steady, steady fall. And you can see how the 20-day moving average for the VIX has formed a perfect resistance point. But look what happened this week. And in fact, starting last week, this is Friday. And in fact, I wrote about this. It poked right through that 17 level. And I just assumed, given that I thought that the indices were on their way to challenging all-time highs soon, the VIX would continue on its downtrend. But it didn't. And I failed to really process what this failure to break through and continue the downtrend really meant. And you can see here, even on Thursday now, we had the bounce. It was a small bounce. It was let's see, what percentage move? That was like a 4.4% bounce, but it was still meaningful in the context of everything else that was happening. The market was up yesterday and the VIX bounced. So that should have been my warning sign. I should have been more aggressively looking for hedges and so on. And you could see the result today. The VIX bounced, it closed up 16% essentially, and it held close to the highs. This means tensions are high in the market, and we need to take this seriously. The 20 level is considered conventionally elevated volatility, and the VIX held above that 20 level. It closed at 20.8. So risk is back on the table, and we need to heed this. And again, I totally missed out on the warning sign that actually came into trading on Friday. There was another warning sign in oil. Now let's get into the individual stock charts. So as we know, oil was the one of the biggest had the biggest impact of the new fresh hostilities in the Middle East. And you could see we were being warned for several days, in fact, over a week going into this. Not only did USO, this is the United States Oil Fund, break out above its 50-day moving average in early June, but after that, it just never cooled off. It just kept rising and rising and rising above the upper Bollinger Band, which is this black line that defines, essentially, it defines, in this case, 80% of expected price volatility. And you can see here this pinch. You see this pinch right here? Again, when I say right here, I'm talking about where the cursor is flashing around. This is a Bollinger Band squeeze, and it resolved to the upside. So that means you should expect higher prices for USO. Then it soared above the 20-day moving average, the 200-day moving average on Wednesday with a large 4.5% gain. Now, granted, I did see this, but I thought it was overstretched and I wasn't going to chase it. And then here again, it gapped down, but then it rallied back up to a small gain. So we had warnings that oil was ready to pop, and boy, did it pop. USO soared 6.9%. I think overnight oil futures were up at as much as 8%. Um, I went ahead and did a fade on this because so many times oil will surge on these kind of tensions and then fall right back as if, all the buyers get exhausted or all the buyers in the market have gotten all the oil they need. So, and I paired this with a Palantir long call spread on Palantir, which I won't show the chart here today, but just know that these are positions I put on. And as a reminder, I present all this information for informational purposes. Please keep in mind your own risk tolerance and investing and trading horizons when you make decisions for yourself. Okay. And I do appreciate likes and shares so the algorithm knows what's up. You can follow this feed, subscribe to my channel. You can read more details on drduru.com/122, all letters. And of course, if you have questions or comments, put them down below. All right, let's continue with some other individual stocks. So, Fluor Corporation finally broke out. I've written about this one. I was really confused as to why it was so weak when infrastructure is going to be a big need. You can see it recovered really well. Actually, let's go all the way back. We recovered really well from this pandemic plunge. And just, it was choppy, but it did have a steady, steady rise. There was this one period in 2023 when it broke down below the 200-day moving average and looked weak. So I finally got on board Fluor. I can't remember the exact buying points, but this big 200-day moving average breakout on Wednesday seemed to validate all the things I've been writing about on my blog about Fluor Corporation, ticker symbol FLR. Now, even if you don't believe in the infrastructure build, now we have all these build outs that are going to come or are happening for AI data centers. And I think Fluor is very well positioned for those. So I am about as bullish as I allow myself to be with stocks that aren't behaving as technically strong overall as I would like as I can be. So I'm about as bullish as I can be, all things considered. So I don't see a case for me to add more just yet. It looks like Floor is probably going to drop back to its 200-day moving average support, and then I'll see if it can hold that on a pullback. Then I want to buy more in this area and just hopefully ride it to higher prices. All right. So on the other side of the ledger, let's take a look at Roblox, every kid's favorite. Ticker symbol RBLX. Look at this nice steady uptrend. I don't know how I missed this 50-day moving average breakout. I think I've talked about before how I was helping my daughter with her stock market contest in her econ class in high school. And the contest, I had her in Roblox for a short amount of time. You know, it was too short of a contest to do much, but I really lost track. Particularly, I didn't want to be in and ahead of earnings, but look, Roblox survived earnings very well. And the issue, of course, I would have as a person who prefers to buy off of support is that Roblox, see this area where it pulled back? It didn't quite pull back to the kind of support I prefer. It hasn't even come close to this nice uptrending to 20-day moving average. So this is a very strong move. Now it's getting close to the psychologically important $100 point. So again, it's something that I probably am not going to touch. I'll just have to admire it from afar. All right, energy drink maker, Celsius Holdings. This is an interesting one. It is a one of these classic from bearish to bullish reversal stocks. You see how it broke down below its 200-day moving average actually almost exactly a year ago. And it never even came close to challenging that again until March. And since it got above its 200-day moving average in March, it has been doing really well. It's consolidated, it survived earnings, it broke out earlier this month, and I like it here. I want to buy it. I haven't pulled the trigger yet. Again, I'm biased to wait until some kind of natural support gets tested. So if it can touch this 20-day moving average, I probably will be a buyer. And then if it falls to the 50-day moving average, I'll buy again. But I wouldn't buy again if it falls all the way down here, because then I'll be worried that I've totally read this situation wrong. Okay, but so another thing is I like plays like Roblox, like Fleur, like Celsius in this kind of environment where the hyped up speculative stuff is probably going to get slammed really hard in the next sell-off. I just don't want to, that's part of my risk management. I don't want to chase those kinds of stocks. These ones seem to be a little bit more robust if in case this sell-off really accelerates. IBM amazingly broke out to all-time highs. Actually, I guess it broke out to all-time highs a few times. One was in May, and I didn't take this signal seriously enough. Again, as you could tell, according to my trading behavior, I should have bought IBM with both hands right here. Look at that nice test and rebound. It rebounded 2%. It's just that IBM is such a boring stock, but boring is going to be good if this market sell-off accelerates. So I am looking for a cool off from this latest breakout to all-time highs. You can see how stretched IBM got, almost parabolic move. And again, guess what? You know it. If it hits that 20-day moving average, I want to be a buyer. All right, so that's IBM. Oh, and the big news this week for IBM is that its quantum computing solution is looks like it is advancing along really nicely. So put IBM in the camp of both an AI and quantum computing play. McDonald's is on the edge. You can see how well it held up through the tariff trauma, drama, and noise in this big consolidation. You want to see the stock break out above this. It has not yet. So it's kind of in no person's land. It held 200-day moving average support pretty well this week. But man, the minute it confirms a breakdown, I want to be short McDonald's just for technicals, no other reason. It looks like it's in trouble now to me because it's just barely clinging to the support. So I've got it on my short list. It's nowhere near a buy for me, even if it rebounds from here, just because I don't like the way it's stuck in this muck here, wide-ranging muck. That's a scientific term, by the way, muck. Okay, Dave and Buster's Entertainment Incorporated, ticker symbol PLAY, Play. I have been a big proponent. I've written about Play for a while. I mean, the case that I've always made has just simply been follow the insiders. The insiders have been loading up on Dave and Buster's stock. The last time was this big purchase by the CEO way back in December, and that seemed to work out pretty well, but then the sellers took over again. I don't know why there are so many skeptics of the insider purchases, but what I did is I bought along the way down. I don't know how many times, I can't remember, but I did enjoy this nice breakout, but then my resolve uh, kind of weakened as earnings approached. So I sold ahead of earnings, took the profits that I had made, and look at this. Dave and Buster's surged 17.7%, bullishly broke out above its 200-day moving average. And now all I can do is hope that it pulls back a little bit to this line, 200-day moving average, as support, so I can begin the buy again. So now the stock is finally above, once again, where the CEO loaded up on stock. So at this point, I don't expect Dave and Buster's to get much lower than this on any kind of pullback. So I've got my finger on the button, ready to go if support gets tested. I'm not going to chase this one higher. Again, that's just not in my MO. Now, even though I just said chasing higher is not in my MO, let's take a look at Etsy. I wrote about this one because I looked at Etsy after eBay broke out to an all-time high, and look at this amazing run up. I could not find specific news. I did write about Etsy on my last blog post, and I did a comparison between what the company said at an investor day, I think it was, between earnings. And the main thing I could see, the main difference I could see is just that they said that the latest moves against Temu and Shein were going to be a benefit for them. That was the main difference I saw. So, but still, I don't think, whatever. I like the technicals here. This demonstrates, even though it's overstretched, it's demonstrated a strong stock. So I took a small nibble, very low risk position, which was a calendar call spread at the 65 level. Um, and I believe it's a 65 calendar call spread. Don't quote me on that. You can check out my blog to see the details. But anyway, this is why you don't chase stocks higher for long anyway. Look at this sharp pullback. I mean, at the intraday high, looks like, yeah, Etsy hit 65 exactly, which was my target. But I didn't expect it to hit it that fast. And now from there, sellers have just scrambled to take their profits. The stock fell all the way back to 20-day moving average support. So it lost 10, 10 points, sorry, $10, which, if my math is right, is about 17, maybe almost 20% drop straight down. And this is, of course, what happens when a stock just moves so fast up. You just collect up so much pent up selling pressure, selling demand, because people want to take their profits. This is a nice move. Anyway, um, again, I wasn't looking closely. In fact, I'm surprised it got all the way down. I mean, the last time I checked Etsy for the day, it was only around 57. So it wasn't at a point that I wanted to buy. Now it's up back on my buy list. I want to start to add shares. I want to add to my call position, assuming that this 20-day moving average support holds. I shouldn't have to explain this to you now based on what I've been saying about other stocks. You could see that Etsy is moving into a well-supported phase, which is the 200-day moving average is starting to stabilize and turn upwards, and the 50-day moving average is already moving upwards. So I feel really good about buying shares and just holding them to see what the fuss is all about when it broke out and just went straight up. Hopefully, this isn't just some sort of short covering move. All right, let's move to, speaking of shorts, Restoration Hardware, or I guess they just call it RH now, ticker symbol RH. This is an ugly fade. This is very bearish. I think RH was up as much as 19% after posting earnings in the aftermarket. And it did what we call a gap and crap. It gapped up higher. I think it gapped up maybe 16%. I can't quite remember. And then sellers pretty much just took over for the rest of the day. I mean, if the day was a little longer, they probably would have eaten up all the gains, but Restoration Hardware did survive with a 6.9% gain. This is a heavily shorted stock. I heard that it was about 20% of the shares outstanding, or the float is sold short. The CEO actually also owns a large portion of the company. I think I heard 18, 19% of shares. So that means with the shorts gobbling up just as about as much shares as the CEO, short squeezes are bound to be very sharp and violent. I don't know what to make of this. The earnings report, I saw the headlines, I read a little bit, listened a little bit, and didn't seem impressive to me. So I have to assume this is just a short squeeze. And, if you want to continue playing the short squeeze, you look for what's called a calm after the storm. This is something I learned from my favorite stock scanning tool called Swing Trade Bot. And if sellers stop on a dime and the stock starts to stabilize here, and then the next day up, you want to buy it. Sorry, I shouldn't say you want to buy it. It could be a buy. I'm not sure I'm excited about trying to play that game, but I'm going to keep an eye on it because I like to see how these kind of moves play out. All right, let's take a look at Starbucks. In fact, I didn't even check Starbucks during the day because to see how it survived. Ah, look at this. So Starbucks got back on my radar because on Wednesday they had some good news, and I forgot to label it here. I think it was good news about their business in China. It surged 4.3%, stopped cold at the 200-day moving average resistance. Of course, it caught my attention, me wondering, okay, can the buyers push through? Nope, they could not. You could see how Starbucks faded away from this, and today's, of course, drama and geopolitical tensions did not help. Now the stock is in no man's land. If it's going to pull back, I don't want to buy it until it hits again. You guessed it, the 20-day moving average support. But I do assume that sentiment is now starting to change again on Starbucks. Let me just pull back to show you how choppy and directionalist the stock has been for a while. You could see there was all that excitement when they got the new CEO, and then all that excitement pretty much faded by the bottom in April and May, completely wiped out the gains. And now Starbucks is slowly but surely trying to repair itself. I wasn't brave enough to buy Starbucks here, but I do think things are changing and it's rounding the corner again, changing for the positive. So just have to be patient to wait for a good entry point. Definitely not going to buy right after this bearish failure at 200-day moving average resistance. All right, last stock, Adobe. Now, Adobe reported earnings. It was down 5.3%. Look at that perfect test. Let me zoom in. You can see this perfect test of 50-day moving average support. If I were interested in trading Adobe, ticker symbol ADBE, I would have jumped on this at some point today because you can see it's also overstretched to the downside, well below its 50-day, its Bollinger Band. So it's overextended to the downside. So if I were interested in trading Adobe, I would have jumped all over this at any point down here after seeing this 50-day moving average test happen and succeed. But when I pull back, and I'm surprised, Adobe has not been doing well for a long time. I mean, its all-time high was way back in 2021. It made a lower high here in actually between 2023 and 2024 while it totally underperformed the market last year. Last year was a strong year. The S&P 500 was up, I don't know, 20% or so, and Adobe essentially was stuck in this overall downtrend for the year. And then it opened up the year trying to make a rebound, and then it collapsed, of course, into not collapsed, but yeah, it did collapse. It had a big 14% post earnings drop here. Now, of course, it almost healed up, but look, this also makes me suspicious. On the rebound, it didn't quite close the gap before sellers took over again. So Adobe looks like it's in trouble in a market where things were looking strong, and the S&P 500 and the NASDAQ were almost on their way to testing their all-time highs. Adobe is a huge laggard. So I will keep an eye on it, but I just don't like it, as you can tell. Anyway, so that's all the individual charts. As a reminder, the market actually let's pull up the headliner here, which is the percentage of stocks trading above their 50-day moving averages. This is the headline. Overbought conditions have ended. And this means that the buyers are a little bit more wary, a little bit more, they weakened a little bit. And typically this would be bearish for my AT50 trading rules, but the S&P 500 and other indices are well supported. So it is only for the very quick and nimble to try to short this market at this juncture. And even if the pullback extends, it's going to be tricky, at least for a person like me, to try to get bearish. So again, as a reminder, what my plan is if the S&P 500 closes below that first support level, I'm going to flip neutral and just take a step back and be much more wary about the market's trading action. All right, thanks for checking in. Hopefully you'll subscribe to this feed and you will check out the coming videos in coming days and weeks. Take care and stay safe out there, all right? Take it easy.